Едем. Hello, everybody. Sergey here. Welcome to another episode of Sellerscale Show, where we get the chance to talk to amazing people from the Amazon FBA and e-commerce space. Our today's guest is Ilya Kulyatin. He's a chief operating officer at Nimble Seller, which is a financial technology startup with a vision to make e-commerce completely capital-free for online entrepreneurs. We'll be discussing topics such as financing and growing an Amazon FBA business, as well as proper cash flow management for Amazon FBA. Ilya, thanks for being here. Welcome to the show.
Thanks a lot for having me. Hope you guys will enjoy the talk. I'm sure you're doing a great job with all the communication you're doing right there. So happy to be here.
Yeah, awesome. Let's start off with, do you mind describing when you meet an average Amazon seller, for example, at a conference? How do you typically introduce yourself and explain what your business does in the plainest terms possible?
Sure, it's not usually that easy because it's a novel product.
Yeah.
It's in the financial space. People usually understand this and usually fear this kind of product. But how we explain it. So we are a buy now and pay later for e-commerce for Amazon sellers. So let's say you sell on Amazon US. What we do, we go to your supplier, we buy your inventory in bulk, and then we sell it to you much later in the game in smaller batches. So it practically unlocks your capital. So instead of blocking your money for up to 6 months, your cash conversion cycle, so the days between your outlay of capital and when you get your money back from the sales, so the cash conversion cycle reduces from up to 6 months down to 2 weeks or even less. So that's practically what we do. And how it helps, it's sort of a business solution. So it's not a loan, there is no interest rates, there are no credit checks, nothing of that. We don't require any collateral, any guarantees. And how it works is sort of a business solution because once we onboard you, you stay on our platform and we follow your sales. So if we see your sales picking up, we add new orders. So you never risk running out of stock. So this sort of, and you don't even need to spend your own money for that inventory. While we are employing our own capital for your inventory, you can just invest it in marketing, in your business expenses like just acquiring new customers or business development, or managing your personnel, so hiring new people.
Right. So it sounds really beneficial to sellers who might be experiencing cash flow problems or maybe problems with restocking their inventory because Amazon bans the listing if you don't restock your inventory on time, right?
Mm-hmm. Yeah, so people usually think about these solutions as emergency solutions, but we think it's wrong. So when people are cash constrained, they start thinking, okay, well, maybe we need a loan, maybe we need to ask a bank or some friends and family. Right. But in our opinion, you as a businessman or a businesswoman, you don't have to think about this. So it's more financial and fintech stuff. So we think about it, so you don't really use it as an emergency, but you have to have it in place. And you're right. So why you do that? To avoid running out of stock. Because for instance, Amazon, why is a perfect solution? Because if you run out of stock, you lose your BSR. So it just can kill your business right away. So you go out of stock once, you lost months of work.
And I mean, what's the next biggest difference between you guys and just general bank loans, interest rate aside?
So interest rate is not the main. So obviously there is flexibility. From a bank, if you scale, if you grow, let's say you got a loan, you bought inventory, and in 2 weeks your sales just picked up. Your sales velocity double because you have great marketing. Maybe you acquired a great mentor that helped you. But the bank won't give you again any money. We can react right away. If we see your sales picking up, we just submit another order and then just go through your same pipeline and you get that inventory right away once it gets to your final market.
Makes sense. And I see from your website that you and your founder, you've had experience working with AI, big data investment, risk management, a lot of different topics and industries. And I wonder, at what point did you decide to switch to building Nimble Seller? Is there any story that fueled that transition?
Yeah, so the story starts actually from my co-founder. It unfortunately couldn't take this call. And he used to be also in finance. His previous life, he used to work in London. He's a British citizen, working mainly with derivatives trading. And then he switched to building private label brands. So he had his own brand selling on Amazon quite successfully, so with good exits. And he was facing this issue of working capital. So where to find
Right.
money for your inventory, how to scale, how to increase your growth.
Right.
And that chased him for years. Then after that, sometime a couple of years ago, he started investing himself in working capital solutions for other sellers. So he was just buying out inventory for the others, had around 40, 50 different deals, and saw that it was a very interesting business. Then we met and decided, we were discussing possible business opportunities and how we could help the e-commerce e-commerce sellers. And that's where we thought, oh, maybe we can put my data analytics skills and my financial experience together with his e-commerce expertise and
Right.
come up with something useful. And that's where Nimble Seller was born. So a totally new solution that's been available for dozens of years with bigger brands. It's called structured trade finance. So that's partly what we do. And we just make it available to smaller players that actually need this even much more.
Exactly. And who do you have more, smaller sellers or bigger sellers?
Let's say our average clients make between 200 to 300K per year USD in sales, but
Right.
we go from anywhere between 100K and 1 million plus in annual revenues. So usually what we do, we help our clients with bulking up. So they buy up to 3-4 months of inventory, and that can require anywhere between 15 and 100K in inventory, let's say, at this moment in time, because it's quite risky. So right now
Exactly.
the demand is a bit lower because it's very hard to get your inventory into Amazon, or you have to go with, for instance, fulfilled by merchant rather than fulfilled by Amazon. So right now it's slightly lower, but the range is that. So let's say revenues between 100K and 1 million.
It's an interesting business, And you have an excellent blog post on your website, and you say that it's called Why Growing an E-commerce Business is a Pain and How to Deal with It. For listeners who haven't read it, could you briefly explain why it's hard to scale an e-commerce business on and outside of Amazon?
Sure. So that article was mainly for cash flow issues. So where
Right.
cash flow is a problem. So it's when we talk about the cash conversion cycle. What does it mean? As I explained previously, it's the number of days between when you outlay your capital to buy your inventory and when you actually get the sales. Money you
Right.
get from Amazon for your product. And this cycle tends to be quite long. So in order for you to replenish your inventory, you need to wait for the money. So you tend usually to reinvest your own revenues, and that just dampens your growth. You can't get more market share, so your competitors win, and sometimes you run out of stock. So that also kills your BSR. So that's how e-commerce can suffer because of mainly cash flow. Not only the cash cycle, the length of cash cycle is important, but also the uncertainty. So how do you deal with it? If you suddenly have certain Q4 or the Prime Day, for instance, when you have a ramp up in sales, you need to increase your capital, but then after that you need to decrease it. It's very hard to do it with your own capital to forecast
Right.
how much capital you need. And and the proposal in the blog was just to take care that first you try to reduce your cash conversion cycle as much as possible, and second, also forecast your cash needs way ahead in the cycle. So try to understand when you will need the money exactly day by day.
Right. And before I ask you how you do that, I just wanted to point out that you also need to finance your PPC advertising, right? So if PPC is a major part of your sales, then you take out a big chunk of your revenue, just put it back into ads. And if you do that, you don't have enough money to restock, especially if you need to order more products, right? And
Absolutely.
yeah, and you mentioned that how do you deal with a smaller cash cycle that you mentioned?
So how can you reduce that? Well, first you can try to get better payment terms, starting with your suppliers. So suppliers usually obviously prefer in the beginning to get 100% ahead of time. So you
Right.
just pay and then wait for the product. Never do that. So try at least 50-50 split. Usually the industry common practice is to pay 30% beforehand, and the rest is paid right at the production end, so at the delivery of the product. And you can obviously, once you work a little bit more with your supplier, you can extend these terms. We have some clients that, for instance, pay once your product lands in your destination market after customs clearance. So that's a great deal. Second, you can also play on determined payment terms with your logistics providers. For instance, you usually don't pay right away when you book a vessel, but when it departs, you have 5 to 10 days to pay your shipper, your freight forwarder.
Right.
They sometimes offer also payment terms such as net 30. You pay 30 days after the shipment lands, gets to your destination market. So that's also perfect. Right now, it's very hard to get these kind of deals because in order to get this deal, first, you need to be relatively big and have a good bank relationship because the bank will have to provide a letter of credit for you.
Right.
Second, shippers and freight forwarders are having major issues in this particular period with this. So you'd be lucky if you just have to pay a couple of weeks once the shipment departs your source market.
So there's absolutely no chance for new sellers to avoid, as you say, that suppliers are usually using sellers to finance themselves. So you have to grow big and you have to have a good relationship with the bank in order to do that, right?
Well, actually, no. You even as a new seller, you can just negotiate. It depends on where you source your products. If you source in China and India, for instance, you have to negotiate, and that's expected. If you source in US, maybe less, but they have more credit availability, so they can also offer you better terms. We just always try to negotiate, even if you're a small seller. Never try to put 100% of down payments. Just do 50-50 or 30-70. And with the freight forwarders, once you ship 5-6 times with them, you can try to talk about better payment terms. So it's all relationship business. You need to first understand them, see how they work, and then also they need to understand how you work, if they can trust you. Most of our clients, given that we don't really do novel products, we have clients that have an established business. They've been selling a certain product for anywhere between 3 and 12 months. And those have already decent relationship with their suppliers. And where it helps also is when you can increase your orders. Once you start doubling whatever you order every 2-3 months, you have much better terms.
Right. Sounds like good advice. And for someone who's listening to us and he's not there yet, he's just starting out. For example, imagine that seller is done with their product development. They have $5,000 on hand and they're just about to place their first order with a supplier. What should their strategy be on their first order from a cash flow perspective? Now, what I mean is, should they stock up using all of their $5,000 and reinvest profits, leave some for the second order on PPC? What's the right balance here?
Well, that's a very tough question. So there are lots of different variables in play right here. Well, let's think about on the cash flow side. So that's our area. Let's say you need to think about how competitive is the niche. Okay,
Right.
If the niche is not very competitive and your cash conversion cycle is pretty short, let's say weeks, not months, then you can safely invest almost full amount, and because you'll get your money back very fast to reinvest in your other sales. And here we assume that you already have separate capital for your marketing, for your logistics, right? This is just for your inventory, correct?
Right.
But if your niche is relatively competitive and if your conversion cycle is, let's say, a couple months, 2 to 3, 4 months, then you have to be more careful. So I would just start with 1/3 of these $5,000 spent in your inventory. You send it to a destination market, you start selling it, and then you add another shipment once your sales velocity starts to ramp up. So you're talking about sales velocity. You need to also try to understand where is your competition. You look at the first page of the products where you compete, your competitive market, and you try to understand their sales velocity. And through that, you try to also see what would be your conversion cycle, and based on that, you decide, right? Obviously, last, to answer this question, I would think pretty carefully about profit margins. It's where tools such as yours can come up very, very handy. Is that
Right.
if you understand your profit margins and you can see when your product will pay you back, then you can be more precise with with submissions of new inventory orders. If your profit margins are quite healthy, I'd say you can safely invest most of these 5K and then just get your money for the next batch while you're selling. Let's say if you buy for $1 and you sell for $4, then you invest let's say 2/3 of your 5K, and then right after a month of sales, you can reinvest in new batch. So, but while if your profit margin is negative, you need to take that into account, that you'll need probably several months to grow your product and pay back and be able to buy new inventory, right? So then you will have to split this 5K in several months. So, and probably you won't even be able to do that. So 5K won't be enough. So it's very important to understand the profitability of your product. And luckily, people can use several tools out there. And once I've seen the demo of yours, I think it's a great solution for this question, to answer this question.
Yeah, I think it's a very overlooked aspect of just product management and product
Absolutely.
development. Yeah, I think that unit economics is key here. And the other thing that you mentioned is just figuring out the profitability of every product and playing with assumptions, understanding how different scenarios in the market or sales velocity, how it can affect your profitability and just your cash flow. Yeah, I think that's very key. Thanks for that. And speaking of funding, right, because you guys are mainly focused on funding sellers. What funding options are currently available for Amazon sellers except for Nimble Seller?
Sure. Obviously, it depends also on which market you are. So if you have your
Let's say the
company and your
US market,
LLC
Amazon
registered
FBA.
in US, well,
Yeah.
so if you sell in US, you can still be based, let's say, in Pakistan. You can be based in Russia. You can be based in
Right.
India, Singapore. So in that case, you can try to first talk to friends and family. So that's where you usually start: friends, family, angel investors, if you need more of an equity kind of investment. Then after that, you go to banks. For instance, in US, if you're based in US, you have SBA loans. It's not easy to get them because of how long does it take. But once you get it, it's a pretty good and stable, availability of capital, and also quite cheap. So if anybody has access to SBA, so small business administration loans in US, definitely try to access that. Just to have it as a reserve. You don't have to deploy it, and you wouldn't pay for that. But just to have it in cases like the current one.
Right.
After that, there are also different solutions like alternative lenders. This tends to be more of an emergency solution because they tend to be quite expensive. So if you look at the alternative lenders in US, I've seen annualized returns, annualized cost of capital of up to 50%. Even if some of them say, oh, it's 14.99 APR is annual percentage rate, you need to be careful. You need to really understand
like
what's in
microfinancing.
there. Exactly. And I'm not sure that should even be legal because it really kills your business. So you need to understand it quite well. So that's why we came up with this solution, because what we do, we charge a small percentage between 1 and 2.5% on your retail price. So you just you see what's the input on your profit margin. That's it. And then last, obviously, you can also get, as I was saying, you can get access to investors, but that's also more for equity. If you let's say want to expand to a new market or a new product, then you might want to sell part of your venture to a business partner.
Right, interesting. And I wonder, at what point should a seller consider financing? Because you probably want to do it. You probably want to look for loans or apply for SBA loans in the US when you're just starting out, right? You're using your own savings, your own money in the proportion that we already discussed if you had a 5K. Now, is a point when sellers consider financing a function of revenue? Do you have to be a certain revenue or maybe certain product categories or something else?
So there is a life cycle of your enterprise, right, of your business. I think the financing needs to be there at any time, from the beginning up until the maturity of your company. In the e-commerce, in the smaller e-commerce space, where you have, let's say, sellers that make between 100K and even several millions, there is a little bit of lack of education on the financial side. So people think, I don't want that. it's something I fear. What if I'll owe somebody and I won't be able to return it? That's obviously a very good that's very good thinking if your business is not very profitable. So, but if your business is mature, that's perfect. Why not using debt for leverage? But getting back to your question, at what cycle, you can start whenever you are. So let's say from the beginning, you can get startup capital. For instance, in countries like Singapore, banks can provide you working capital even if you're a startup. FBA loans very hard to access if you're a startup. You need 2 to 3 years of business activity. That's why players like us have the opportunity to enter this market, because we don't need that loan.
Right.
Once you grow your company, once you grow your e-commerce business, you can right away go talk to your own banks, maybe also get some increase your overdraft capacity of your credit card. I would never use credit card first for e-commerce because it's very dangerous and very expensive, but just have it just in case something happens. And after that, once you mature, you can talk to your bank because it could be a much cheaper source of capital, and then advance from there. But what I think is that you have to think about this financial help at any stage of your company, because this can really help your business to grow and to compete to win against your competitors. Because most of the big D2C brands are using these tools. They use trade finance, for instance, invoice factoring. But you can't if you don't look around.
Yeah, but it sounds like what you're saying is just bite as much as you can chew, right? So you have to see what you can handle, what kind of risk you can handle. But still, I mean, if we're talking about benchmarks, if we're talking about the proper risk management balance, how many months of business activity, business history, business sales history do you have to have before you can apply for a loan and not really fear that you won't be able to repay that debt?
Mm-hmm. Well, talking about loans, again, our solution is not a loan. So you can start whenever you want, as long as you have the sales, because we obviously help you understand if you can support our business model. But I would say that in e-commerce, already after 6 months, you can really see if your product is going well and you can afford getting a bit of capital. Obviously, never try to get very short term, like for instance, credit card debt, but get something for longer term, or solutions like the one we are offering, because it's totally linked to how you sell. So if you sell less, we'll just submit the next order for your inventory replenishment later. So and the money is not getting out and you don't have to pay. But once you've been selling for at least 3 to 6 months, I think you can start already talking to at least alternative lenders. Banks will be, again, very hard if you don't have at least 2 years of your business activity, and if you're not a registered business.
Do you recommend anybody to use financing like yours or bank loans to finance their Amazon FBA businesses, or can a business survive without it?
Well, the business can definitely survive without it. I mean, you'll just grow slower. You'll be reinvesting your own revenue, but why risking market share? And plus, if your business can support additional leverage, if it can actually grow, if it's not the product that has reached the maximum top of its niche,
Right.
all of the market share, for instance, or it's more top 3 and it's not selling even more, then I think you need to think about the financing. So you need to survive and to thrive in your business. But yeah, if you're able to have your own capital, and that's enough to scale your business, if your margins are very high, then you'll be able to survive for quite long. But margins don't last long, so you still need to take into account that for the future, and at least be prepared to have some solutions, to continue having something, to have financial resources to leverage your business.
Agree. Ilya, I have one last question for you. It's our traditional question. It's actually from Peter Thiel's book, 0 to 1. What truth do very few people agree with you on? Or what is your contrarian view that goes against commonly accepted notions in the industry?
Mm-hmm. Yeah, I like Peter Thiel. He's because we're also in the startup space. The guy is very known. It's a great question, and it's a link to what we've just discussed. So a lot of people in e-commerce space, we notice especially, don't understand the value of leverage. So most of them think that you can grow reinvesting your own revenue. I disagree with that point. So it's very hard because of the competition. So you can't grow if you have the Chinese, for instance, competition,
Right.
and you're selling based from US, for instance. It will be very hard to compete on the volumes. So you need somebody to help you. That's my, let's say, contrarian view for the e-commerce industry, specifically for Amazon sellers.
Well, actually, Peter Thiel's contrarian question is the fundamental question, or it's the basis question that every startup founder has to ask themselves. So it's actually funny how usually all startup founders have this question at the core of their business philosophy. I mean, it should be that way, right? So where can sellers
actually fits perfectly, yeah.
Yeah, where can sellers learn more about you and your business?
They can learn about us on our website, nimbleseller.com. They can find us on Facebook, on LinkedIn as well. And just, reach out and have a chat. We are always open to have a call, a coffee around Singapore or whatever we are. Last time we visited Prague, for instance, before the lockdown. We've been in Bangkok last year. We're planning to go to London soon. So, well, hopefully. So we can meet whatever, online or offline.
Amazing. Thank you for this. Hopefully see you soon.
Sure.